previous session, we discussed about what do you mean by trading on equity and what do you mean by leverage effect. So, in that we discussed about what do you mean by capital structure. Capital structure is the composition of various long-term securities in the capital employed of the business. Now, to decide how much in the form of equity and how much in the form of debt should be raised, the manager has to take into consideration various factors. So, in this session, we shall be discussing about the various factors which should be taken into consideration while deciding about an ideal capital structure. What is going to be the proportion between debt and equity? Now, the factors are cash flow position. Now, the company's cash flow position is a strong determining factor about the composition of securities. Interest payments and principal repayment of borrowed funds have to take place irrespective of the financial position of the company. If the cash flow position is good, then the company can meet out its commitments as and when they fall due. In case if cash flow position is not stable, it is very volatile. It is safe that the company employs equity and less of debt, because the company is under no obligation to pay the dividend or repay the principal amount as far as the equity shares are concerned. But debt warrants compulsory payment of interest and repayment of principal amount also. Therefore, cash flow position should be taken into consideration while deciding about the composition of long-term securities. The second one is interest coverage ratio. This ratio is calculated to measure the availability of profit to cover up the interest on long-term borrowings. If the net profit is higher in terms of coverage of interest on long-term borrowings, the situation of the company is very good. Interest coverage ratio is calculated by dividing interest on long-term borrowings from net profit before interest and tax. So, net profit before interest and tax divided by interest on long-term borrowings. If this ratio is higher, it indicates that many number of times a company will be able to meet out its interest commitments. Higher the ratio, greater is the ability of the organization to meet out its fixed interest commitments. So, if the profits are higher, if the interest coverage ratio is higher, the company can confidently employ more of debt and less of equity. Interest is a short term, is a very limited scope. I won't say it to be short term, it has a limited scope. Now, any company raising money in the form of debt may not prefer to hold it on for a longer period of time. The company would want to repay in easy installments so that its commitment towards the borrowers, towards the lenders come down. Its liability, interest liability also comes down. So, a more comprehensive ratio will give a better indication of debt or equity, what is called as debt service ratio. While interest coverage ratio takes into consideration only the interest component on the long-term borrowing, debt service ratio takes into consideration the preference dividend, which is also a fixed amount to be paid, interest commitment plus the principal installment that has to be repaid. Any company which is raising money in the form of debentures would want to repay the debentures in yearly drawings by equal annual drawings or unequal installment. That means every year some amount of debentures will be repaid, so that at the end of the period the company will have less commitment to. So, in this case, if the debt service ratio is higher, greater is the ability of the company to meet out the principal repayment and the interest commitment. So, the company can confidently employ more of debt and less of equity. The next is return on investment. Return on investment talks about the overall profitability of the company. Return on investment is computed by the formula net profit before interest and tax divided by capital employed into 100. This capital employed consists of debt and equity. So, if the company's overall return on investment is good, that indicates higher profitability of the company. In that case, the company can employ more of debt and less of equity. If the ROI of the company is much lesser than the rate of return payable on the borrowed capital, it is a very dangerous situation for the company to employ more of debt. The next one is cost of debt. Cost of debt talks about the prevailing interest rate. Prevailing interest rate on borrowed capital. If the prevailing market interest rate is higher, whatever the amount of profit the company is going to earn will go in the form of interest commitment only. The company will not have anything to pay to the equity shareholders. Therefore, if the cost of debt is lower than the ROI, then the company can consider employing debt. Now coming to next one, after cost of debt, we cannot ignore cost of equity also. Though we say that equity shareholders do not carry a fixed return on investment, there is a general expectation that if the rate of interest payable on the borrowed capital is more, then the amount of return on investment available to the equity shareholders will come down. When it comes down, the shareholders' interest is coming down. Their interest in purchasing shares is coming down, which means the market price of the shares will come down. Investor unrest will be there. So, to avoid that, the company has to take into consideration the expected return on investment to the equity shareholders also. A considerable return is expected even by the equity shareholders. So, cost of debt and cost of equity, they both have to be considered while determining an ideal capital structure. The prevailing tax rate, we know pretty well that debenture interest is a tax deductible source. So, the company will deduct tax at source and remit only the remaining interest to the debenture holders, which means the company will pay bulk tax to the income tax department. Thereby, the income tax department will give concession for payment of bulk tax. The benefit will go to the equity shareholders. So, if the tax rate on the borrowed capital is higher, then the company can employ more of debt. If the tax rate is normal, it is better to employ more of equity. The next is floatation cost. Floatation cost, like already I told you, floatation cost is the cost of printing of prospectus, payment of brokerage commission and underwriting commission, etc. If the company's financial position is satisfactory or good, the company can afford to spend money on floatation cost, then the company can confidently go for employment of more of equity and less of debt. On the other hand, the company is not in a position or does not want to spend money on flotation of funds, the company can employ more of debt and less of equity. The next is risk considerations. Please remember, risk indicates financial risk. Financial risk is nothing but the obligation on the part of the company to meet out its fixed financial expenses. When the company employs more of debt, its financial risk automatically increases. If the company's financial position is good, satisfactory, and it can afford to take up the financial risk, then the company will go for more of borrowed capital. If the company is not so sound to take up the financial risk, the company will go in for equity. The next is flexibility in capital structure. Please remember, preference shares and debentures can be raised whenever the company wants and can be redeemed whenever the company has got surplus funds. If the company prefers to have a flexible capital structure, then the company can go in for employment of more of fixed cost sources which can be raised and redeemed anytime at the convenience of the company. The next is control considerations. If the existing shareholders do not want dilution of control, the company has to go for borrowed capital. If the existing shareholders do not mind dilution of control, then the company can go for additional funds in the form of equity shares. The next is regulatory framework. The guidelines given by SEBI from time to time regarding the funds to be raised in the form of equity or debt should be taken into consideration. It should not in any way violate the provisions of SEBI and go for unhealthy speculation in the stock market. The next is stock market conditions. If the stock market is showing a bullish trend where more purchasing power in the hands of the investors are adventurous in nature, they would want to invest more money in equity shares, it becomes easy for the company to raise money in the form of equity shares. On the other hand, in a bearish trend where the prices are falling, investors are very cautious. They don't want to take a chance. They would not prefer investing money in equity shares. They would prefer investing money in debentures, which case the company can raise money only by the issue of debentures. And the last factor is capital structure of other companies. Capital structure of other companies means to be on the safer side. Any company would prefer to use a very similar capital structure which are adopted by the industry, by the particular industry. So, if all the industries in that, if all the companies in that particular industry follow a prescribed pattern of debt versus equity, it is better to employ the same proportion so that industry variations will have the same impact on all types of companies. So, that should also be taken into consideration. To recollect what we discussed so far, capital structure is the composition of long-term securities in the capital employed of the company. The manager has to decide about the proportion between debt and equity. To decide about the composition of securities, he has to take into consideration various factors to decide about the choice of capital structure. Now, in that we discussed about cash flow position. Cash flow position talks about the inflows and outflows of cash and cash equivalents in the business. If the company's cash flow position is satisfactory, sound, it can meet out its interest and principal commitments as and when they fall due, the company can confidently employ more of debt and less of equity. But if the cash flow position is not satisfactory or it is not stable, it is safe not to invest money not to raise money in the form of debentures. The next is interest coverage ratio. This ratio measures the ability of the organization to meet out its interest commitments as and when they fall due. This is computed by net profit before interest and tax divided by interest coverage ratio. This is expressed in number of times. This is expressed in number of times. So, higher the number of times the interest is covered by the net profit earned by the organization, the company is very sound, financially very sound. It can meet out its interest commitments as and when they fall due. But it is a narrow scope because we take into consideration only the interest component. But most of the companies which raise money by the issue of debentures or by borrowing from financial institutions, etc., would want to repay the debt as and when possible in equal installments or unequal installment and don't want to hold on bulk amount of commitment for the maturity period. Therefore, every year as and when possible, the company will repay, which means a wider ratio is always preferred, what is called as debt service ratio. In debt service ratio, we measure not only the interest commitment but also the preference dividend payable plus the principal installment repayment. So, here we take into consideration net profit before interest and tax and preference dividend plus interest plus principal repayment. We can easily make a comparison between interest coverage ratio and debt service ratio. We can make it very clear that debt service ratio has got a wider scope than interest coverage ratio. So here again, higher the ratio, greater is the ability of the organization to meet out its fixed obligations as and when they arise. So that being the case, a company can confidently employ more of debt and less of equity. The next is return on investment. This ratio is computed to evaluate the overall profitability of the organization. This is computed by dividing net profit before interest and tax by capital employed into 100. So, this ratio indicates overall profitability. Higher the profitability, greater is the ability of the organization to meet out its fixed commitment. So, if ROI is more, then the company can employ more of debt. The next factor to be taken into consideration is tax rate, that is, interest rate, the prevailing interest rate, that is cost of debt. If funds are available at a higher rate of interest, that means the company's commitment towards interest becomes more. The company has to decide whether it should necessarily raise money by paying higher interest. The company can go in for equity in place of debt. Now, the prevailing tax rate. Now, any income payable, any expense or interest payable is a tax deductible source. So, the company has to deduct tax and pay only the balance to the debenture holders or to the lenders. So, if the prevailing tax rate is high, the company can employ more of debt because company will have more tax concessions. The next is cost of equity. When cost of debt increases, automatically the expectations of the equity shareholders also increases. Why? They feel rather insecure that more amount is being paid in the form of interest, the money available to them in the form of dividend will become less. When that dissatisfaction prevails, automatically they start selling the shares. So market price of the shares will fall. So to avoid that situation, the manager has to ensure a reasonable return on investment to the equity shareholders also, what is called as cost of equity. The next is risk considerations. Financial risk is the obligation on the part of the company to meet out its fixed financial cost. When more of debt is employed, automatically the financial risk also increases. So, if the company is very prudent not to go in for much of a risk, it's better that the company goes for more of equity and less of debt. But if the company's financial position is satisfactory that it can go in for taking up more financial risk, then the company can employ more of debt. The next is flexibility, the ease with which the capital structure has to be framed. If the company wants to have a flexible capital structure, that is, raise funds whenever required and repay them whenever not required, is possible only when the company employs more of debentures and preference shares. So that factor should be taken into consideration. The control. The existing shareholders' preference should be taken into consideration. If the existing shareholders do not mind dilution of control, the company can raise additional funds in the form of equity shares. But if the existing shareholders would want to retain the control by themselves, it is better that the company goes for borrowed capital. The next is regulatory framework. The guideline given by SEBI from time to time regarding the issue of shares and debentures should be taken into consideration. The next is stock market conditions. If the stock market is favorable for shares, like showing a bullish trend, increase in price of shares, more investors will be willing to invest money in the form of shares. In which case, the company can easily raise money by the issue of shares. On the other hand, if it is a bearish trend and the prices are falling, investors will not prefer to invest money in shares. They would be cautious in their selection of funds. In which case, the company should go only for borrowed capital than owner's equity. The next one is capital structure of other companies. To be safe, they can follow the capital structure that has been adopted by the other companies of the same industry, so that any problem or advantages taking place will be there for all the companies of the same industry. So these are the factors determining the choice of capital structure. So, Namaste. In the next class, we shall be discussing about fixed capital management and working capital management. Thank you.